Did you have your raw milk this morning for breakfast, Kevin?
I can't say I've ever tried raw milk, Martin. How about you?
I have had a little bit of raw milk, not in the form of raw milk, but in the form of unpasteurized cheese. And before I moved to France, my general view was I was like very afraid of food poisoning. But in France, it's like just the cost of doing business. I pulled up the Wikipedia. So we're talking about raw milk because RFK is moved on from raw milk to whole milk as what he's pushing, and which is seen as a politically safer choice. The Wikipedia article about raw milk is funny because these two sentences are right back to back on it. Many French cuisine traditionalists consider pasteurized cheeses almost a sacrilege. And then it's like ... Unpasteurized cheese in France is the major source of staphylococcal food poisoning. And that's just the vibe there. The cheese is better, but you might get some food poisoning.
As we often talk about, there are trade-offs to everything.
Trade-offs and everything, including getting some food poisoning with your cheese.
Yeah. Having had food poisoning once, it is not something I particularly want to roll the dice with getting again in life. Personally speaking, yes.
Yeah, I feel that. Well, it is almost the top of the hour. It is Monday, April 13th. I am streaming in from Mile High City, so it is almost 11 a.m. here, noon in HTN local time, and 1 o'clock on the East Coast. We are switching things up this week and starting with a guest at the top of the hour, Gabe from Pearl Health, and he's going to chat with us today about the new ACO LEAD. So I'm going to bring him forward, and then Kevin, you can kind of kick us off.
Yeah.
Gabe, welcome to the show.
Great to be here. Thanks for having me.
I am very excited for this conversation today, both learning more about LEAD generally speaking, but then also digging a little bit into this idea of inferred risk and the paper you co-wrote with Abe Sutton on that topic specifically. But I guess at a macro level, for folks who are new to LEAD, learning about LEAD, I would love to hear your Pearl's perspective on LEAD as kind of next step of ACO REACH, what changed in it, why it matters, what you're excited about and thinking about for the program on the whole.
Yeah, absolutely. So as you referenced, LEAD is the successor model to ACO REACH coming out of CMMI. And I would think about it as at a high level as really a sort of mixtape of ACO REACH and Medicare Shared Savings Program sort of mashed into one program. Borrowing some attributes from the shared savings program, but really a spiritual successor to REACH. And in general, CMMI, when developing and launching new models, has a mandate to think about sort of what are the major developments that they want to introduce into a model successor to justify it over, an extension of REACH, for example. And LEAD really emphasizes a few things. One, the integration of specialists and having pathways for them to have a defined role in a total cost of care model, whereas ACOs have, historically been very primary care centric. That's how you align beneficiaries, is through primary care enrollment, et cetera. So finding pathways to bring specialists more into the fold. Two, an emphasis on the consolidation of different cohorts of populations across Medicare. So in ACO REACH, there was a distinct track called the high needs track that was very oriented towards patients in the final year or two of life. And practices had to decide, well, do I do a high needs track and have a more appropriate benchmark, a budget that I'm sort of managing against, or do I go standard track and bring in my whole population, but not necessarily have sort of the credit for the deterioration in health of my sicker patients? LEAD sort of collapses those so you don't have to make that choice. You can have a standard track ACO with high needs eligible beneficiaries. And then, as you referenced in some of the materials leading up to this, they're looking to test what is called AI-inferred risk. And this is really just a notion of recognizing how much attention and time we have set aside to what was originally a good idea, right? Like risk adjustment in its sort of infancy was oriented around making sure that risk bearers were not incentivized to cherry pick healthy patients. What it then became, though, was a whole industry that has cropped up around how to maximize the budget that you get from the government. And so the idea of inferred risk is to say, well, let's remove that moral hazard and the administrative burden of documenting HCCs, documenting risk codes and diagnoses, and instead infer those diagnoses from the utilization of Medicare beneficiaries. So I would say those, there are a lot of areas that are really exciting about LEAD, but if I had to pick 3 sort of headlines, those would be where I'd start.
Can you talk to us a little bit more about how the old risk adjustment model worked in REACH and how that compares to the new sort of proposed inferred model?
Yeah, absolutely. So in general, across value-based care models, you have a number of ingredients that sort of sum up to your benchmark, the budget against which you're judged, and generate savings or owe the government losses if you come in above it. There are a number of factors there, like forecasting trend, regional versus national trend, and all of that. But at the end of the day, what they are looking to do is trend forward the costs associated with a sort of counterfactual, unmanaged version of this population to give you that baseline against which you're going to manage those costs. And risk adjustment is one of those main ingredients. As you can imagine, having a sicker population will lead to a larger budget. And historically, these programs have largely been oriented around the prospective HCC model. And what that means is if I'm looking to set my benchmark for 2027, it's actually the risk scores and coding and documentation that I do in 2026 that will impact that. I did mention sort of this high needs approach where recognizing patients in sort of the final chapters of their life will have their health trajectory deteriorate more rapidly. Those patients will benefit from the concurrent risk adjustment model, which is sort of same year coding on a quarterly basis. So that's one aspect of it. But in general, what the risk adjustment regime is seeking out from providers is a confirmation of a diagnosis that's substantiated by a clinical encounter and charts and notes that warrant that diagnosis, and then ultimately appended to a claim to provide that diagnosis to CMS.
Gabe, one of the critiques I've heard of predecessors to this LEAD model, well, 2 critiques, I suppose. One being this idea of ratchet effects and how that penalizes the highest performing ACOs and penalizes you more the more successful you are. 2 being the potential for, and I know this is a loaded term, but gaming of who's in, who's out of the model with NPIs versus TINs and some calculus going on there. I'd be curious your experience and thoughts as kind of we transition into LEAD and how they're addressing some of those issues, if you see those issues in previous models and how it attempts to solve those going forward.
It's a great question. There are certainly, so ACO REACH, as you're referencing, was a TIN NPI based alignment program. So you could go down and sort of identify the individual providers that you wanted to bring into an ACO, as opposed to the entire tax ID or billing organization associated with the practice, as the Medicare Shared Savings Program has done. LEAD takes the latter approach. And so certainly a sort of overt reason for doing that is moving away from the ability to quote unquote cherry pick providers or cherry pick risk. It is favorable to an organization participating in value-based care and have more of the overall Medicare population present in value-based care, which has been sort of a bipartisan, consistent message coming out of CMMI for the last decade or so. And so, I think at the end of the day, what organizations are going to have to navigate is a pretty uncertain benchmark period going into the first years of LEAD. The 2027 launch of this program will look a lot like launching a 2027 MSSP ACO, where your baseline period that's sort of informing that budget, one of the other ingredients I referenced, is 2024 to 2026. And so we're living in that right now for at least a large part of that look back period. And so organizations, on the one hand, will have to make sort of a semi-informed decision on whether LEAD is right for them versus MSSP for next year. On the other hand, they'll have sort of less opportunity to quote unquote game the system, pick the providers that are going to have the largest tailwinds. I think it's a delicate balance and one that CMMI recognizes of being able to enter value-based care with some momentum behind you, because I think many of us have observed that once a provider group owes shared losses and is paying a check to the government, they're unlikely to stay in value-based care and unlikely to come back for some time. But at the same time, this entire enterprise cannot be sort of a financial arbitrage. It has to be something that's net accretive to the Medicare Trust.
Gabe, you and particularly, but Pearl Health, the organization that you help lead, have a unique perspective on this because you're out talking to docs who are evaluating these programs. Curious what you're hearing in terms of reactions to the announcement.
So to my last point, I think there is an overall recognition that provider groups are going to be making this decision with relatively less information than they've had in other enrollment cycles. The RFA just came out about a week ago. The application deadline for the ACOs is May 17th. They're going to have to decide whether provider groups and which provider groups enroll by early August, and then lock in their decision by early September. Again, part of the budget period is still happening right now. And it takes a fair bit of time to sort of reconstruct the rules of these models, digest the RFA. The sort of standard detailed financial methodology hasn't been released yet. And so there's a lot of ambiguity that a provider group is going to have to navigate compared to the past few years with a relatively well understood ACO REACH model. At the same time, you referenced ratchet effects earlier, and LEAD has a 10-year stable benchmark. And so once you do sort of come in and understand what you're being judged against, that is largely going to stay consistent for the entirety of that 10-year model. So I would say likely going to see maybe a more gradual ramp compared to the Global and Professional Direct Contracting Program that launched in 2021. Where there was basically a land grab of entities, venture-backed, PE, et cetera, looking to bring as many providers as they could. I think we'll see a bit more caution going into LEAD, but I would anticipate that it's a very successful model in 2-3 years down the road.
I'd be curious on the topic of inferred risk adjustment again. In the paper you guys wrote, you talked about testing it via CMMI type model. And in my mind, implication is if it works here, I would imagine you'd be looking at expanding this inferred risk approach to broader population, MA on the whole. I'd be curious how, having co-written that paper, thinking about it in LEAD, and then thinking about potential for inferred risk moving forward, there's a lot of questions folks are asking about risk adjustment, leveling the playing field. How would you see that playing out? How would you think about expanding beyond LEAD to broader population of inferred risk?
So I think to start, we have to see sort of how it goes in LEAD, right? So far, all we have is a couple paragraphs in the RFA indicating that this will come out down the road, starting as sort of like a sidecar that's not going to have financial impact, but that ACOs can observe, and then moving into, just as V28 was introduced, sort of a gradual replacement of the V28 with the inferred risk approach. So I think everything is predicated on a successful rollout of this in LEAD. At the end of the day, I wouldn't anticipate that it's going to have a net inflationary or deflationary impact compared to V28. What I would anticipate is to your point, a level playing field between organizations that have not had a strong history of documentation versus those that have. And so, right now, if you're looking at coming into an advanced risk model, and you haven't been doing documentation, you're likely coming in with material headwinds because your benchmark is just deflated as a result of not properly documenting the conditions of your patients. And so, if you can infer risk from utilization, that is no longer a problem. And so I think that will open up the aperture of groups that can engage in LEAD. To your broader question, sort of what happens from there, the original CMMI strategy statement when this administration came into office indicated that they were looking to test this in Medicare Advantage. The latest proposed rule, request for information and feedback, had a whole page on inferred risk in MA, looking for responses there. And CMMI has made broader statements saying that we haven't done a lot in MA before, and we're looking to do it now. So I would imagine success in LEAD from a inferred risk perspective would lead to an MA-oriented model where you have seen most of that inflationary impact of the HCC regime.
I know we only have a couple minutes left because you have a busy rest of your day. And so where I was hoping to leave it is, one of the things we talk about a lot when we talk about value-based care is this trade-off between simplicity and complexity, getting the things that we want while making it relatively easy for individual doctors to be able to do these sort of things. Curious, sort of as you take a step back philosophically, how do you feel like LEAD is making that or handling those trade-offs?
At the end of the day, I have a hard time imagining any sort of small practice or coalition of small practices getting together, reading this 200-page document and saying like, yeah, I totally get what is being asked of me and I can understand how I'm likely to perform. Like, there has been, to your point, this longstanding desire to make value-based care sort of sufficiently elementary that you can just sort of jump in. I don't know if that's necessarily a realistic goal, which is unfortunate, but I think as long as you're looking to have providers come into full risk models with upside and downside, which is the stated goal, moving away from just sort of pay for performance where some of that simplicity is more readily available, you're going to have a lot of actuarial assumptions baked into that to make the benchmark fair, both for CMS and the providers. And I think that just comes with complexity. Now, I'm admittedly a little biased. Pearl's job is to help sort of explain that to providers and help them navigate it. But it's certainly, I remember sort of when Pearl was started, reading the original RFAs for direct contracting, like it's dense. It takes a while to sort of wrap your head around what this world is asking of you. And I don't think we're necessarily there yet. So,
Gabe, this was hugely helpful. We're going to let you run and get back to the rest of your day. But before you run, where can folks learn more about what Pearl Health is up to and how you're helping docs navigate these things?
Absolutely. Well, if you go to pearlhealth.com, simple enough, there is information there on what we do, as well as the ability to contact us. And we really view the initial discussions with provider groups as very much a consultative process. And many times we'll say, X offering that Pearl has available isn't right for you, and be sort of that non-biased guide through value-based care. So we welcome any of those discussions.
Thanks so much for your time, Gabe. We'll see you.
Thank you for having me. Take care.
Thanks, Gabe.
That was super fascinating, and we're really lucky because later on we're going to talk a little bit about some of the sub-capitation arrangements with specialists. But in the meantime, we had what a week in healthcare. I mean, I said in the newsletter this morning, it's been less than 7 days, full days, since the MA final rate notice has come out.
I feel like we're saying that every week these days. There's a lot coming at us. It makes for interesting talk shows like this, right? Yeah. Final notice came out last Monday. Obviously, I'm sure everybody listening to this already knows final notice results. Number came in at 2.48%, up from the 0.09 in advance notice. This caused MA stocks to go up across the board. I think most were in that 10% range. Reading the news this week and getting to talk to Chris Klomp early in the week, I thought there were two stories that summed up the narrative really well. One was that interview with Chris Klomp, hearing it from himself, talking about where the final notice number came in at, the intent behind that, how he seemingly viewed it as a good outcome that it came in at around GDP growth. I thought that was an interesting data point. The other, as a Minnesotan, our local newspaper here, the Star Tribune, covered a story around Blue Cross in Minnesota and how they have been changing their benefit design for seniors here in Minnesota, much to the chagrin of those seniors. You're pulling up the photo now. This photo is going to stick with me for a long time. It is 50-ish, I think, seniors in the state of Minnesota who are picketing Blue Cross at Blue Cross headquarters over the fact that they lost their lifetime benefit from Blue Cross plans. Martin, do you have any sense of why Blue Cross of Minnesota might have pulled back on this gym membership for these seniors?
Yeah, a couple. I mean, so you and I are both very fond of the Healthscape regional nonprofit insurer thing and white paper. And Blue Cross Blue Shield of Minnesota is one of those insurers. They just inherited UCare's MA book. They have some tough choices to make. And Lifetime, for those of you who are not, is a gym franchise, and people love it. And so if you're an MA member and you were used to getting your Lifetime membership covered, yeah, it's disappointing. You might even go out and pick at the local BCBS MN. But also, sure, BCBS MN has some tough choices to make. And as you can kind of make an argument for a gym membership, but it's also not core to the health insurance offering. And so it seems like something reasonable to trim.
Yeah, the Star Tribune article is actually about the financial issues Blue in Minnesota, to your point, is facing as they inherited UCare's MA membership. UCare went under because of its financial issues with both MA and Medicaid. And Blue, as you mentioned, has some tough decisions to make. That was kind of the thrust of the article. They had that winner's curse of attracting all those new members to come in. And this is where, to me, it's a fascinating juxtaposition of what's happening in one market in this country with what CMS must be thinking about on the whole, where after advance notice, they talk about the fact that they got 44,000, I think, comments in from the industry on where the rate came in. It's not hard for me to imagine, given what we heard from the public payers in the space, that there'd be some pretty draconian benefit cuts that the plans were saying to CMS, hey, like, this rate doesn't keep up. We are in real dire straits financially. We're going to have to make some big cuts. And if that were to happen, you would have this scenario playing out over again. And so when I listen to Chris Klomp talk about this notion of stability, of predictability in the Medicare market, Medicare Advantage market, of wanting to support that market, I think about stability not only for the plans, but also for the members of these plans and the folks in Minnesota who are like, I want my lifetime gym membership. Martin, why did I lose that? I used to get this for free under UCare. I loved that. Then I was really sad UCare went away. Then I had to go to Blue Cross in Minnesota. Blue Cross in Minnesota backed out of this. And like, you're just perpetuating the cycle potentially. And so to me, it's entirely logical that this final notice came in slightly ahead of where people were expecting, at a place where it's not high enough where plans are going to feel like it's business as usual. They don't have to change the way they think about managing medical spend. I think CMS made its point there, but it's also high enough where you ease some of the concerns around those benefit cuts, right? Like I think it came in at a really nice spot in that regard from a final notice perspective, personally.
It's one of those areas where no one is going to be happy, right? No one is going to be happy with this. The insurers didn't get everything that they could have wanted. It's coming in roughly at GDP growth. The members are going to have some abrasion. They're going to lose some of the benefits. They're going to be a little bit less generous. And the government's still paying more than it would like to. And this was the way to cut the cake. And I think it's overly simplistic to say, well, if everyone's upset, then it must have been a good call for the politics. But I think in this case, it's accurate, right?
Yeah, for sure.
There was no way to make all three of those parties equally happy.
No, I thought it was interesting in that context to the reaction I heard from folks over the course of the week was, okay, 2027 came in a pretty good spot. Now, what does that mean for 2028 and beyond? Obviously, the big change that caused the final rate to go up for 27 was risk adjustment and pushing back some of the proposed changes that they were making to risk adjustment. And I think it's an interesting question to think about. Like, a lot of the question is, well, is the risk adjustment change just going to come in 2028 now, and we're going to be dealing with that headwind just another year out? And I think the answer is in the definitely maybe category, right? I think, at least as I heard Klomp talking, I heard him signal while it might not be the explicit goal, it feels like a good place for final notice to come in at roughly GDP growth in that 2 to 3% range. Okay, that's the goal for the bottom line number, roughly where we should expect this to come in at the future. It's then an interesting math exercise to figure out how do you get to that number. And if the top number, the effective growth, the growth rate is in that 5% range, and you need to get down to 3%, guess what? I would expect there's going to be more risk adjustment conversation, more changes. We just talked about inferred risk adjustment. It seems like they are thinking about concepts like that. What is the impact of those changes? TBD. But I'd expect on the whole, they're trying to get to that 2 to 3% number, right?
Yeah. It's also important to note that CMS says, okay, this is the number. And also, here's an asterisk. We also expect coding intensity to increase. And so we're actually think that this will come in closer to 5%. 4.96, I think, is the number that they say in the press release. And so, well, I think that this was a good step, and V28 was a good step for us. I also have to imagine that there is more pain to come. And if we want a sustainable Medicare program, one of the things we need to do is spend less money and have the growth rate come in slower than GDP growth. And so it's going to require people losing their gym memberships, unfortunately.
Yes. One of the other things that I think was important in what Klomp was saying, I heard him mention a few times, it is payers need to do a better job managing costs in the MA program, which I think has been covered pretty extensively publicly. But he also made a point to say providers and health systems need to do a better job. And I can't help but wonder if that is going to be more of an emphasis here in 2026, 2027, is thinking about the provider's role in deflating healthcare costs, if you will.
It feels like everyone has had their turn in the hot seat so far, except for the providers, though I know some hospital systems have gotten dragged in front of Congress recently. Yeah. It's
an OBB.
Yeah. So, so that's definitely top of mind. We have a guest coming on in 10 minutes, and before he comes on, I want to talk a little bit about Teladoc and BetterHelp. You pointed out an activist investor letter that got published last week. Can you talk through a little bit what is going on with Teladoc?
Yeah, it seems like in a bit of a pickle. They are currently trading, I was checking this morning, market caps around 900 million. I think enterprise value is slightly higher than that. Last week, activist investor sent a letter suggesting they're not thrilled with current performance of the stock and how the company is being managed, basically suggesting that decisions over the last few years have caused the markets to lose faith in management, causing the stock price to lag. That, in large part, is due to a combination of what are in hindsight ill-timed deals, i.e. Livongo, deals that have not contributed to earnings in a meaningful way yet, despite potentially having a strategic logic to them, a lack of stock buybacks as the stock has gone down. So that's an interesting element to play here. And an unclear future strategy. A part of the activist investor letter was essentially saying, we're not sure where the company is headed, and we haven't heard that articulated from the current management team particularly well, which is an issue, right? I mean, that is your job as the management team of a public company to help investors understand the opportunity at hand. The other issue is that the letter was actually, as my read of it, oddly optimistic in kind of a backhanded way to the management team, because it essentially said there's actually a lot of tailwinds at play here. There's international expansion, there's BetterHelp getting into insurance, there's a favorable regulatory environment. And essentially it was like, where it's currently trading at, whoever makes an offer to take Teladoc private is going to make out like a king and capture all the upside that exists in the stock today. Which, good news, bad news, right? There's upside that exists in the stock. That's a good thing. Management can go execute against that if they can generate confidence in the markets again. Bad news being they don't have that confidence today and it's trading where it's at. That was then compounded, it seems, by the Talkspace deal the other week, where Talkspace was bought, I think, for $800+ million at multiples that were better than where Teladoc and BetterHelp are trading at today. And that Talkspace comp has essentially provided folks with a comp to say, here's what Teladoc could be doing and what BetterHelp could be doing. And so there's a really interesting Substack report by someone named Saki Georgiadis. I'm sorry if I butchered that name, that highlighted kind of the math behind this BetterHelp opportunity and the transition here. And he comes up with an enterprise value for BetterHelp by itself of 1.5 to 2.5 billion by 2030, largely predicated on this transition from D2C business to insurance business, driving the valuation for the company moving forward, which is an interesting dynamic because Talkspace underwent a similar transition too, right? Talkspace was a D2C business that went over to insurance, but it wasn't as big of a D2C business. And so the transition into insurance was potentially easier for it to make over time. And that's the question for BetterHelp moving forward. It is just starting this pivot. Revenue is just starting to grow in the insurance segment for them. And that is going to be the valuation driver. But if you buy that they are actually going to be able to execute on that, that's a meaningful business for them, right? And so it's the takeaway from that article is that a PE firm should come in and buy out BetterHelp, which aligns to what the activist investor is seemingly worried about, which is a PE investor is going to come in and buy BetterHelp and take all the upside from BetterHelp. And it'll be interesting to watch where that valuation comes in over the next couple of months, because I'm sure there's a market for it. And I would imagine there are conversations ongoing, given Talkspace just filed their merger docs. There was a ton of interest in Talkspace, right? Like they went through in the merger docs, they talked through the timeline and background of the merger, which is always an interesting read if you're interested in these markets. And they talked through how they blind all the company names that are interested as potential acquirers. But there was company A through company I that were strategic and or financial potential buyers in Talkspace. And I'd imagine that implies there's also a market of folks who are interested in talking to BetterHelp as well.
Yeah, this from the Substack is a PE-owned BetterHelp could run the same playbook at 10 times the scale. And you're like, oh, okay. That's real interesting. There's so many themes here that are things we like to hit on. The challenge of being a publicly traded company right now in healthcare and how much nicer it looks on the other side of the markets when you're privately held and can execute some of these things. The seemingly insatiable appetite for behavioral health services that we have in this country and the platforms that can meet that demand, the preference for consumers to use insurance and insurance looking for affordable, reasonable opportunities there to staff their networks. And I think it feels a little bit like Access is the CMMI program is just waiting in the wings a little bit on these conversations, which is looking for opportunities to use AI to significantly scale things like BetterHelp, because it's really expensive. You know, they're paying 70, 80, 90 bucks an hour for sessions. So there's a lot to this story, and I think it's a good one. I also appreciate any sort of activist investor drama. It's just fun. It's fun to watch.
Totally. Yeah, that Access point, I think, it's one that you and I will probably be musing on a lot. I don't know if I would expect to be hearing about that in Teladoc earnings calls anytime in the immediate future, although it would be certainly interesting if it does come up. The other last thing that I thought was really fascinating about this is there's some irony to me in the fact that Teladoc is taking it on the chin at the moment for a series of mismanaged acquisitions. Livongo was what, 18.5 billion when that happened, which is always a eye-watering number to think back and look at. BetterHelp BetterHelp, on the other hand, was acquired for, I believe, roughly $5 to $6 million in early 2015, which, if it at some point sells in the billion to 2 billion range by 2030, that looks like a really nice acquisition for Teladoc to make. Now, I don't know that anybody could have predicted the sequence of events that would have led to that outcome over the intervening 10-year period, but that seems like a pretty good return on capital over that period of time as it turns out.
Yeah, that's going to go down, assuming the story ends there, it's going to go down and be talked about in the same sort of hushed, irreverent tones that the Instagram acquisition by Facebook is. We'll just like,
I don't know. Yep.
$6 million and you flip it for $1 billion. Like that's pretty great.
It is going to be, as the Substack post noted, it is going to be worth keeping an eye on Teladoc's quarterly earnings this year to see how they're tracking against what they are projecting as insurance revenue growth for that BetterHelp business, because that is going to be what drives the valuation here, it seems. So that'll be kind of the thing for us to keep track of over the next couple quarters.
It's this private markets aspect to the question, I think, is an interesting one. And there is this seeming divergence between private and public markets, increasing appetite in private markets, increasing capital availability of capital in private markets, allowing companies to stay private for longer, and for there to just be sort of interesting moves in the business world. One of the things I always enjoy hearing is from investors who are investing in private markets to get their perspectives on these things. And so that kind of leads us up nicely to our next guest. Do you want to tee it up a little bit, Kevin? And then I will bring him forward in a couple minutes.
Yeah. Always excited to bring a good Minnesotan onto Health Tech Nerds Radio to chat about lifetime memberships and whether or not MA should fund that as a benefit. Conor Green, who's at TrueHelm, has been investing in healthcare for Conor as long as I can remember our conversations going back. So excited to learn from you today about state of TrueHelm, how you guys are looking at the world.
Thanks for having me. Yeah, I was jotting a couple notes down. I actually went to Lifetime this morning, so you guys this is very timely for me. I appreciate it.
Was there a noticeable lack of or fewer MA beneficiaries there?
There were, if you go, some days I'll go a little later, like I'll have calls in the morning and go a little later. And there is a very clear 9 o'clock hour where you can just tell that some group of MA beneficiaries has, I think it was Silver Sneakers at one point. I don't know what it is. And I haven't, unlike if Kevin were there at 9 a.m., he'd probably be interviewing people for the, for the blog, getting some content. But I have not done that. But it is a very noticeable shift in the demographics, let's say.
There was, going back in the Star Trib articles, Conor, there was I think it was early 2025. They talked about how an interim step before they took away lifetime memberships was they bracket the hours of it, so you could only show up during the day, and those were the senior hours. So I am sure there is something to that. To that dynamic and lifetime.
There you go. Yeah. Well, very happy to be here. The Minneapolis, St. Paul, kind of the headquarters of HTN, or maybe the original headquarters. So honored to be here. I told my son this morning that I was going to do a podcast with Kevin O'Leary, and he's a big Shark Tank fan. So I had to unfortunately let him down a little bit after that, but he was excited.
I exist in a perpetual state of letting people down when they realize that I am not that Kevin O'Leary, unfortunately. Conor, give us the latest on TrueHelm. I know you guys just went through a recent rebrand from Triple Tree Capital Partner CP to TrueHelm. Talk me through where you guys are at, current state of investment thesis, fund deployment, that kind of stuff.
Yeah. Lot of pressure following Chris Klomp and the head of CCMI last week, or CMMI last week. But I feel like I'm on the pod mostly because I emailed Kevin this week to just say we rebranded, and he was like, "Come on and talk about it." But yes, I've been at my firm for over a decade. We spun out of Triple Tree, which is a leading healthcare M&A advisory firm. That started in Minneapolis and has now grown across the country. we started a investment firm inside of those four walls back in 2012 or 2013. We raised two funds inside of TripleTree, and then a few years back, TripleTree got acquired by Capital One. We spun our fund out. We kept our name, which had always been TT Capital Partners. What happened is we just eventually got tired of correcting people. There's just market confusion about who's the bank, who's the fund, who's TripleTree, who's not. One of the aha moments for us was that when we did spin out, we realized that a lot of advisors across the country were kind of withholding some of their better deals just because they thought if they sent it to us, it would get to the investment bank. And so some of the advantages of being inside those four walls were probably overstated maybe, and being independent has actually been great for us. And so we just decided to take that kind of final step and rebrand. So hired a branding expert, and I don't know if you guys have ever done some of that work. It's fun. The name part is a little bit, we're proud of the name. It's meant to invoke kind of a nautical, the helm theme, true being kind of like the true north, steady hand on the wheel kind of thing. The name is probably less important than a real opportunity to kind of sit down and think about who are we as a firm, what are our principles, that kind of stuff. It just made me realize that it's important for everybody to be doing that periodically, because it lets you kind of reorient the company around what's important.
And TrueHelm is focused exclusively on healthcare.
Correct.
You're in the healthcare capital of the world, which is the greater Minneapolis-St. Paul area. And I'm curious to hear a little bit about how you are thinking about deploying capital. Like, what is the investment thesis that TrueHelm has?
Yeah. Thanks, Martin. So our lane is, we really think of ourselves, so we're healthcare only. We really play in this kind of growth equity, or sometimes we call ourselves growth buyout style investors. We're not a huge fund. We just raised our third fund, which is in the neighborhood of 250 million. So we're not the multi-billion-dollar, VCs that I think we could get into and talk about a little bit if you like. But our power alley is really finding these usually still founder-owned or founder-controlled businesses that are tech-enabled services companies that are selling into the industry. So they have hospitals or health plans or large employers or life sciences companies as their customers. I think under a different lens, you might call that digital health. But we really gravitate towards situations where they've kind of skipped venture. We really like these businesses that have been kind of bootstrapped, have gotten to a certain size and success, and look around the corner and say, you know what, I could use some capital to maybe I have a co-founder that wants to retire, or maybe I want to go buy something, or maybe I just see my competitors raising money and I've been really kind of stingy historically, but I'm ready to put my foot down on pushing hard on like building out sales and marketing, for example. So our investors, are composed of both traditional financial style, university endowments and those kinds of things, as well as health plans and hospitals that have invested either out of their, some of their different vehicles or directly off their balance sheet. And so the idea is that we can bring some of these parties to the table. We're really deep in the space. The kind of the TripleTree heritage has sort of made us think about this space now for going on 2 decades. And the idea is just find great businesses and help them grow faster. That's where most of our returns come from. And so like just to kind of click into a couple of recent examples out of our third fund that we've made. One is a behavioral health EHR called Cantata. Really interesting sourcing story there, if you guys want to get back to that. Another one is called Collaborating Docs. That's a business that had been founded by an MD. She had raised no outside capital. She got the business to be north of 20 million in revenue, very EBITDA profitable. What they do is they basically serve as a marketplace, is one way to think of it, between nurse practitioners that want to practice in a more entrepreneurial fashion, maybe start their own business or join one of these VC-backed companies that are kind of expanding across the country, and the docs that in 35 states are required to supervise their work, right? So that business kind of touches a few different themes: staffing, compliance, kind of the the necessary grunt work of kind of succeeding as a healthcare company in this country. That those are kind of the situations that we gravitate towards.
Yeah, Conor, I'd be curious, kind of a state of the market from where you sit. Where we sit in the ecosystem, we hear a lot about AI activity. We see all the funding rounds. We see the AI ops platforms being built, folks chasing after that. We see this dislocation between private public market valuation, some of the exit concerns around credit markets, what's going on there. How would you articulate how you guys are looking at the landscape kind of across those categories?
It's the most confusing time of certainly my last 12 or 13 years of doing this. It's very confusing out there right now. And there's a big dislocation between what I or my colleagues might think a business is worth and what others might think it's worth, including people we compete with, right? I think there's like the what is the market is sort of a it's sort of an N of one experience right now. It's the old cliche, but like high quality businesses continue to drive great outcomes and great results, but there's just a big messy middle right now of things that are going to require a little bit of work, are still trying to figure out what is their business model going to be. Is AI going to be going to help boost their gross margin, or is it going to crush their revenue, or both, right? And so it is a very confusing time. And then you kind of layer in just the unpredictable kind of government activities, like the level of the pace and level of change across the healthcare industry in the last 12 months. And then you couple in like debt markets and oil prices and everything else. It's been confusing. So I don't know if I'm answering your question, but that's been the hard part. One anecdote that we were chatting about is, look, we're Midwestern, we're conservative. We do our best not to overpay for companies. We'd rather get around the table with somebody, create a lot of rollover where they're not taking a lot of chips off the table, especially if it's a founder that owns a lot of the company, and we're trying to align with them. And so the price that we pay today should matter theoretically a little bit less than somebody who's like taking a lot of chips off the table. So creating that alignment is hard. When you have bankers in the process, it's even harder because they're trying to drive the values up. And there's a number of situations over the last 6 or 12 months, businesses we really liked in rev cycle and different kind of niches of the space, where we put in what we thought was a good bid and we were told we were too low, and that's not unusual. But then we track those situations, and 3, 6, 9, 12 months later, we'd expect to see something or hear something. Those deals a lot of them are not getting done. Right. And so it's hard unless you're like really inside the process. It's hard to know exactly what's going on. But our suspicion is that there's a lot of retrading going on in these processes where you're kind of bidding the book, we call it. You're just looking at the financials, bidding the book. And then as you really get into it and understand the business and start thinking about the AI threats, which again, we try and front load some of those things and price a business for what we realistically think is going to happen. Our assumption is that some of these processes are just running into problems as people are like, wait, I'm taking on more risk than I thought. I need to slow down. I need to reprice something. I need to push risk back onto the seller. And it just slows processes down a lot, right? And we're seeing a lot of evidence of that right now. We've got multiple processes and bankers that were probably annoying, sending an email every 3 or 4 weeks saying, hey, we really like that business. There's something to talk about. Let us know. And they're like, we're good. We'll let you know. So anyway, I'm babbling, but please, what else?
Insofar as you're willing to share, can you talk about what's interesting to you and to TrueHelm thematically right now?
Yeah. Again, the old cliche of there's riches in the niches, I think continues to be really true across the healthcare industry. As I said, we're not a huge fund, so we don't approach the world and say, we're going to go create a huge roll up, right? Again, classic example of like creating a dermatology roll up is not super interesting for us. Or even just like a multi phase or across all facets revenue cycle provider is not a strategy you'd really see us pursue, because you have to bring a huge capital cannon to that to be credible. And so we tend to gravitate toward the more specialized areas. And It's just healthcare is kind of endlessly fascinating on that, as I'm sure you guys are very well aware. I mean, you fill multiple emails up a week, and your Slack channel with just constant revelations about, I didn't know this was a business, and look how well these guys are doing. Affectionately, we kind of refer to what we do sometimes as hospital basement companies or health plan basement companies, right? It's sort of like the CEO probably doesn't know that this is a vendor they're using, but you couldn't like pry it out of, somebody who's actually getting the work done. You couldn't pry it out of their cold dead hands, right? Or you have to pry it out of their cold dead hands. Those are the situations we look for. And so across, rev cycle continues to just be endlessly interesting, even despite all the consolidation that's gone on. I personally am spending time looking at some of the changes across like the employer and payer tech-enabled services space. There's just huge changes. We kicked tires for a while on some of the different ICHRA providers. You guys talk a lot about that. I think that's just more indicative of some of the huge market shifts that are happening across that space right now. And if you just step back globally and think like, what we try and think about is a business that we're investing on the right side of the industry, right? Is it working on bending that curve back towards something that's sustainable and not going up into the right endlessly? The shifts that are going on, especially in the employer space of how they fund healthcare, is super interesting, right? And so we've just in the past 6 months, we've been looking across like different ways of playing stop loss, the captive space. I mean, Pareto kind of created that market, but there's a lot of fast followers. So I don't know. Those are at least a few of the themes that we've been spending time on.
Conor, maybe one last question for you, and then
Yeah.
I'll let you run. I'd be curious your take on exit market these days. One of the things we're picking up on more and more is virtually every healthcare public company, it's seen, not every, but a lot of the smaller ones are saying, Doximity was asked by an analyst on the last earnings call, like, why are you guys public at the moment, given where you're trading at, given what we think you could be trading at on private markets? It seems like that window is not quite open, given that dynamic. Strategic players are struggling in a variety of different ways, right? The big MA plans facing headwinds in that market for the past few years. How do you see that exit landscape right now for businesses? How are you guys thinking about that as you think about capital deployment over the coming years? Does it change how you view things in terms of what you're looking at from a ROI calculation, or how are you viewing that world?
It does. Yeah. There's a couple things at play here right now. One is that I think you guys have talked about this, but there's just a hopeless kind of logjam right now in the private markets among like middle market private equity funds. And it just has all these cascading effects, right? There's a lot of funds that put a lot of capital out in 21, 22, 23 at market peaks, especially into areas like healthcare services, like, physician practice roll-ups across a bunch of different strategies. And a lot of those businesses don't have natural homes right now, right? Like the joke here in Minneapolis is, as you know, Kevin, is if United Health isn't buying companies this year, like it's pretty tricky to figure out where to sell some of these things to, right? Yep. And so that has had a cascading effects across LPs and other funds being able to raise a new fund or across a strategy that might be differentiated. The LPs are kind of waiting for capital to come back. What we're seeing right now is the market, at least the bankers who tend to be kind of the canary in the coal mine, they're pretty optimistic about the pace of pitches that they're being asked to do. And I think one of the things that has needed to happen is just, again, it's around aligning expectations, right? So a lot of those investors that bought in at high values, they underwrote to get 3 or 4 times their money. The LPs have been applying pressure to get money back. I think at some point that market settles and people start settling for, maybe 2 times their money because they want to stay in business and raise another fund, right? That will clear a logjam. That will allow a bunch of money to flow in a bunch of new directions, including to other PE firms that could show up as good buyers for, businesses across digital health, for example. The public markets are tricky. And I think we're all kind of watching the giant players in the space, right? Like everything's kind of following AI right now. Like the economic growth right now is kind of based on AI, and and caring for, our elderly parents, right? And so like what's interesting is sitting at the intersection of those two things as a healthcare investor means I think we're all kind of hoping that that some of these businesses that have raised a lot of money can get out. And then what'll happen is that businesses that are burning a lot less cash look relatively safe in comparison, and should be able to again create liquidity events for founders and investors. The one thing I talk with the people that we meet a lot is people that ask for advice is I think like 3 or 4 years ago there was more of a premium on how big of a round can I raise and how high of a value. And I do think like this period of market dislocation has pointed out the effects of that to founders. And what I'm seeing is that a lot of founders are a little bit more reticent around raising huge amounts of capital. They're a little less focused on the high price. They're more focused on, if I raise this money, what does that mean about how long before I can exit, and who will that exit come from? And I think all those things are really healthy, right? Yeah. I think like whether we have to live through like a big dislocation or not, there has been a bubble. We need to let some of that air out of that bubble. I think the hard part right now is figuring out like, what does that look like, and what's the timeline, right? That's a lot of people like me get paid to try and predict that, and it's very challenging. What I would say is like, we didn't do any new deals last year because we just could not figure out where the right landing spot was. And I didn't want to close the deal on Friday and call my investors on Monday and say, hey, there's been a big change at the HHS level and this business is now worthless, right? And I think like some of that dust needs to settle for the exit market to kind of pick back up.
Yeah.
Appreciate these insights. We know we've kept you a bit after time. Where can folks get in touch if they have a business they want to sell you?
Yeah. Thanks for having me. I really appreciate it. We are TrueHelm.com, and I hope you enjoy our new website and our new branding. And there's a button on there if you want to talk to anybody, or just ping Kevin and he'll put you in touch with me.
Yep. We'll see you at Lifetime soon, Conor.
Sounds great, guys. Thanks very much.
See you.
Bye.
Bye.
Feels interesting to think about those, like the challenge of finding a market clearing price for some of these assets. It reminds me of something you talked about in the newsletter this week, which is another area where there's some challenge finding a market clearing price between hospitals and insurance companies. Can you tell me what's going on in Pennsylvania?
Man, that was a very well done transition, Martin. I need to applaud you on that. Yes, Pennsylvania last week, Jefferson Health, which I think was Lehigh Valley, was the health system, filed lawsuit against Aetna over a new, what Aetna calls a payment policy that is downcoding visits around this kind of 2 midnight stay concept. So essentially, Aetna rolled out policy 1126 that is automatically seemingly putting cases at a lower severity rate that Jefferson feels like could and should be billed at a higher severity rate. They are unhappy with this because I'm not a lawyer, but my read of legal case, they view Aetna as basically having done an end around on the contract they already have in place, and that Aetna is not playing by the rules and making this change to the payment policy. At its face, when I read the case, I get why Jefferson is upset here, right? They feel like they've got a contract with Aetna. They feel like Aetna kind of unilaterally has said, hey, we are changing how we pay you. And Jefferson provides some good examples. They give one in the case of patient who shows up, seemingly complex case, Aetna codes at a lower severity level and eventually changes it, but not without the friction back and forth between payer and provider. Tale as old as time in the industry, right? I feel like this is what we spend a lot of time talking about, is this friction that exists between payers and providers. Question behind that is who's ultimately responsible for that, who bears that responsibility, and how, and perhaps even more importantly than that, is how do we resolve this in the first place, right? Because I'm sure while that complaint comes from Jefferson, Aetna's side of the story is, guess what, guys? When 2 midnight rule came in place, we had some data analytics team who could show us some data suggesting that providers are increasing the severity and getting paid more for delivering the same care. And we get back and forth in this like he said, she said, finger pointing argument, which to me is, I don't know, it's the state of the ever escalating payer provider wars, the broader conversation we are having around AI collectively, but also the thing I wrote in the newsletter that was my kind of summary is it strikes me in the current climate as two kids fighting over the remote, thinking they're going to get to pick what's on TV next. And their parent, CMS in this case, is coming over to take away the remote and turn off the TV. Like if I listened to Klomp talk last week about payers and providers needing to better manage costs, and then I read this case, I am like, man, this is exhibit 1A. If I'm a CMS staffer walking into Klomp's office being like this, we should change this, like rewind the clock and all of us do better, you know?
I feel like I'm always my role on this program is to sometimes do a little bit of finger wagging, but it's like one option you have is you have these two players in the market who are adversarial do this, right? And it's annoying to everyone, including the patients and the members, and to Chris Klomp at CMS saying like, I'm going to just take the remote away and put on the master, put on what I want to watch. The other thing I'll say is that like the alternatives to this is all payer rate setting, which no one would be happy with at Aetna or at Jefferson if we had rate setting. And so this is what you get. I mean, this is what is on the other side. I mean, there are actually, I will say that is the solution that comes to mind for me. There are probably other solutions to this, but the one that if I were, sitting in that seat, the one that I would say is like, yeah, like, okay, if you can't figure this out, you two, I'm pulling this car over immediately. Yeah. And I'll set the rates.
Right.
I think that this is like an especially interesting conversation. I think that the inpatient stuff and the hospital stuff is where the conversation is headed for the next 10 years. You and I talk about value-based care 2.0 of specialties and subspecialties and these subcapitation arrangements. We do, in fact, have the perfect guest to talk about CARA and subcap and specialty, and that is Will Gordon, senior advisor at Manatt Health. I'm going to bring him on, and welcome to the show, Will.
Hey, can you folks hear me okay?
We can hear you great. How are you doing today?
Excellent. Good. Thank you for having me.
Thank you for coming on. I think that the questions and the stuff we're going to talk to you about today, like I was just saying, is the most important conversation to be having in value-based care right now. Can you start us off by talking a little bit about what CARA is and what it's building on? Give us a little history lesson.
Yeah, and thank you. I feel like everyone that comes on, like a long time, first time to the show and to the newsletter. So I think it's helpful to start with a little bit of context, because I think CARA is one of those initiatives that, as a standalone piece of policy and lead, without that context, doesn't make a ton of sense why it's important. So there's three ideas or themes that have converged that make, I think, CARA really important. So the first is around bundles and episodes. They save money, right? We know that, particularly surgical and orthopedic surgery bundles. There's been a variety of CMS programs over the last 10, 15 years. This is in the commercial space, centers of excellence, and it's fairly clear that these can save money and in some cases actually improve the quality of care. This has been a very big component of CMS programming for 10 or 15 years. The BIPSI Advanced, these were two voluntary models, had dozens of surgical and medical bundles. CJR, the comprehensive joint replacement model, is a mandatory model for lower extremities. TEAM, which went live in January, also mandatory for surgical bundles. This went live just a few months ago for a selected set of hospitals. And then on Friday, I think late breaking in the inpatient perspective rule, CJR-X is being proposed as a scaled mandatory model for all hospitals and later in 2027, again, for those lower extremities. So really good evidence of surgical episodes. Less clear for medical. Just to be clear, I think the medical bundles are not quite as, the data is not quite as robust. And a big part of the savings is post-acute. And we can talk about, why that is there any juice left to squeeze, et cetera. But the first theme is that bundles can save money. But the second theme is that they really haven't been a core part of ACO strategy, despite the fact that we've known they save money for many, many years. And the primary reason we think is that they're just really hard to operationalize. you have to create contracts and agreements. You have to do payment reconciliation. You have to define a bundle, attribution, contracting. You have to recoup fees. It's just really hard to set it up. And then any one ACO may not have enough volume in a certain area. It's just hard to do for an ACO. And as a result, historically, bundles and episode-based arrangements and ACOs have kind of operated in parallel, which has created even more complexity around attribution, competing incentives, et cetera. So CMS tried to address this with the shadow bundle data. This was data that came out that CMS made available to a bunch of different types of ACOs in 2024 that had basically like what would it look like if your patients were in a bundle across a variety or in an episode across a variety of specialties. But again, it's just data sharing. And the third theme, so the first one is episodes save money. The second is ACOs really haven't leveraged them. The third is that specialists historically have not really engaged in value-based care. This is, again, the tale as old as time, right? The majority of specialist care in this country is still volume-driven. This is not a new problem. REACH tried to address this a little bit with this notion of a preferred provider. This was a specialist or downstream provider that the ACO could formally designate as tightly aligned. They gave them some regulatory flexibility to enter into risk arrangements that may not be otherwise available in fee-for-service Medicare. Really CMS's way of saying, ACOs, you have permission to enter into arrangements with these specialists, please do it. But the remaining work really wasn't enabled, the operational. And I like the analogy of the remote they just gave. And another like kid analogy here is you can buy the pajamas and put the pajamas out right before bedtime, but sometimes you just need to help them put it on, right? And that's really what CARA is meant to do, is to take the data, take the arrangements, but actually provide that next push so that these so they can actually be real and happen in the ACO context. So that's where CARA comes in. It's a voluntary component of the LEAD model. So again, this would start in 2027 when these conversations will really pick up. And it allows an ACO to create what's being called an episode-based risk arrangement, an EBRA, sort of like EBITDA, with a specialist. And importantly, CMS serves as that intermediary, the payment rails, like it's kind of like a third-party administrator for that arrangement. So it's a logical extension of this notion of preferred providers, as well as this shadow bundle data, brings it together so that these bundles can actually become real. So it's sort of straightforward. Once you have the context, it kind of makes sense. So the ACO and specialist agree to work together. That happens kind of outside CMS, but those relationships, you need to form those relationships, agree on what what those might look like. But then you go into a share, it's like literally a portal, CMS, the 4i innovation system, and you create a bundle. You create an episode-based arrangement where you can either pick from a predefined set, which is based on existing methodology for episode-based relationships, or you can use what's being called a max flex option, where you customize, you create your own triggers and quality adjustment, et cetera, in the system. You attest that this is what you and the specialist want to do, and then it goes live the next year. And over the course of the year, the specialist continues to bill Medicare as they normally would. So you don't get into the complexity of them having to figure out which patient is a Medicare fee-for-service, which is relevant. It just, they bill normally. And then there's like a reconciliation. It happens retrospectively, where, if you below the target price, you save. If you're over, you can, potentially get recoup some money. And that's it. So obviously the details are much more complicated, how this works in practice, or at least like the underlying architecture, which is why this is important for CMS to do. But it's really trying to just enable these two partners to come together and to give them that extra push to get them into value-based care arrangements.
Will, I am old enough to recall reading the New England Journal of Medicine article about CMMI program performance a few years back. And in that, it talked about one of the biggest issues in rolling out these models was just the operational logistics on platforms that were built in, 70s, 80s, whatever decade it was, decades ago, and the challenges of making sure the data is flowing right and these systems are working properly, and the added cost that happens if you attribute numbers wrong, so on and so forth. When I hear you describing this, it sounds like a pretty forward-thinking platform that I'm impressed CMMI has seemingly put in place and has the ability to execute on. Can you talk about what's had to go in from an operational perspective, with the context that I think you were working on this model at CMMI or thinking about it and recently transitioned into private sector. But I'd be curious what you can share just about what needed to happen operationally to turn something like this into reality.
Yeah, so it's a great question, and a little bit of context. So I recently left CMS. I was the chief informatics officer at the Innovation Center, and so as part of that, this initiative was split across like this really important operational product development build, and then the kind of the policy side. And so I was, really grateful to have the opportunity to drive a lot of the operational side, working with the policy folks. So it is super complicated, and so this initiative is not fundamentally rebuilding the CMS payment apparatus. That is a much larger conversation and complexity. So we're leveraging those underlying rails, but we are surfacing in a way that the ACOs, it will appear like a more modern payment infrastructure. So it'll be like a workflow in a web-based application that allows them to, click and drag, and maybe not drag, but click and select different features. And then all of that stuff that's happening in the background will be more or less traditional CMS payment technology. So not the most modern, but invisible to the ACO. And that's, I think, the key piece, because it's really hard. It's hard for an ACO to do this on their own, and it's hard for CMS to do it. But because we can stand it up across a program like LEAD, we can, all ACOs can benefit from the infrastructure, and they can be more in the business of figuring out what makes sense for them, really defining episodes. And that's like a really important part of the model, is that the episode definition, without getting into the how do you create a change request for the CMS payment system so that these codes map to this place. And so a lot of that is it's work that's happening, but the ACOs don't have to do the work.
Yep.
Well, I'm curious if you have a view. You talked a little bit about how bundled payments have been super effective in surgery. I'm a kidney care guy, and so I think a lot about the kidney bundled payment. Do you have a view on where, like, what's the kind of specialties where this is going to get uptake to start, and where you see potential for CARA outside of maybe those like surgery and ESRD and stuff like that?
Yeah, I think so. There's certainly areas where we know bundles work. I think CJRX, which is a fantastic name for a model, by the way, is a good example of CMS really doubling down on it works. It saved money. We sort of demonstrated that pretty consistently. Now it's going to be part of core policy. That's the whole point of the Innovation Center, right? To do this. So there's that kind of bucket of very clear things that work. There's probably another bucket where there's a lot of ambiguity around whether episodes and bundles make sense. There's been sort of intermediate data, inconsistent data, a lot of heterogeneity in how care is delivered, et cetera. I think that's one of the areas that, and this isn't specifically spelled out, I don't think, in the documentation, but where CARA really shines, that it creates a mechanism for the market and for ACOs and specialists to define episodes the way that makes sense for them. One of the criticisms of the CMS approach is that it's been very top down. Like IPSI had a lot, but these are the episodes, these are the triggers. We're going to risk adjust the way we want to risk adjust. We're going to quality adjust the way we want to quality adjust. It's been very top down, and team is gone through rulemaking. There's obviously public comment, but it's still CMS saying, here are the episodes, here are the hospitals, like that's what it is. And I think there's an opportunity for ACOs or any sort of managed risk type of organization to better define what it is they think will be both cost savings and quality improving, to do it in their local geography based on the specialists that are there. Are there specific centers of excellence, et cetera? And I think what CARA enables is that it introduces that type of competition and market dynamic that will allow episodes hopefully to evolve with what makes sense. And so, to kind of answer your question, I think that's a potential direction here, right? Is looking at what CARA enables. 5 years from now, as it rolls out, it's more mature. We have more evidence, more actual usage. What are the types of episodes that people are actually voluntarily going into? How are they customizing them, for example, and taking that learning and all the data, and all the payment data we have, and the quality and cost data at that point, and then folding that more and more into core CMS policy like CJRX, and as well as Part C and all the and commercial as well, based on this kind of new opportunity to have a lot of different types of episodes that we're evaluating at the same time, kind of many flowers blooming approach.
Well, I'd be curious. I'm trying to work through in my head the financial flows as I think about this model and rolling it out. And I I think I heard you say specialists are billing as they usually would. So am I thinking about it right that ACO is managing this in their contract, and this is essentially a way to generate potentially more savings for patients who are going through the bundles that they are defining with these specialists? But can you walk through that kind of flow of funds for me?
Yeah, so I think one of the stepping back, one of the challenges that CMS has had with bundles historically is that it's really hard for CMS, for the fee-for-service population and the original Medicare population, to do what's called a prospective bundle. This is where you provide the large capital expense upfront to the specialist and allow them to manage it. This is a lot of the commercial bundles are prospective. You basically shop, this surgeon's going to get $30K for a hip replacement. They get the money up front, and then they are, that's basically it. It's really hard for CMS to do prospective bundles because patients or beneficiaries in CMS fee-for-service can go anywhere. And so even if you provide that money up front, the recoupment challenges of doing this retrospectively with a prospective, it's even more complicated. So most of the CMS bundle programming has been retrospective, where the flow, Kevin, to your question, it basically relies on providers delivering care as they normally would, and then CMS after the fact, so after the episode time period is over, and then with a long lead time for claims run out and adjudication, which can be up to 12 months in some cases, then reconciling, okay, here was the target price, here was the actual care delivery price based on all the different bills, all the different claims across different providers, let's provide that back. So unfortunately, CARA, for better or worse, is a similar mechanism. It's a retrospective approach where the specialist will be in this arrangement, but they're going to deliver care as they normally would. They're going to bill. And then at the end of that reconciliation, after the claims are run out, the CMS will be able to actually figure out that target price balance and then deliver savings. So the ACO and the specialist will both benefit from those savings associated with, the episode, if there are savings, right, and getting below target price. And it's a really healthy tension because on the one hand, you might say, well, why don't they just set the target prices really low, more likely to get, obviously to not do well, or set target really high, more likely to save. And because the specialists and the ACOs are sort of at opposite ends of the tug of war here, and so it creates a very natural tension, which I think, we think the hypothesis will create the right target price that will then be, reconciled much, much later.
Well, we are at the end of our time together. Where can folks who are maybe working at a startup or an ACO or a value-based care, and they have questions about this and they want to learn more, how can they get in touch with you or with Manatt?
Yeah, so email me. My email address is wgordon@manatt.com. I'm on LinkedIn, so feel free to reach out. I'm on a Slack as well, so you can Slack me and try to make yourself generally available. Happy to chat and more about this.
Awesome. This was hugely helpful. Thank you so much.
Yeah, appreciate you, Will.
Yeah. Thanks for having me.
Yep.
So that was super helpful. I'd known what CARA stood for, but didn't know what it meant. And so that was really helpful to get my hands around it.
Yeah, as I think I shared last week, I've heard enough people say CARA is pay attention to CARA inside this LEAD model, and I can see why. I mean, it's complicated, right? There's, as Will's walking, there's a lot of logistics to that. But that said, this idea of rolling out bundles in that way, nested under, this is you tie everything you're hearing from Chris Klomp talking about accountable care relationships to what we're seeing there. And it's you can piece together a really interesting constellation in my mind of, if these things work, where they can all go. And we know the million ways in which it's complicated and hard, but it's cool. I like seeing CMMI doing stuff like this. I'm like, oh yeah, that's awesome.
Yeah, it's like a bring your own bundle situation. I'm thinking about our interview with Brad at Time Care, and thinking about, if you're an ACO and you want to do value-based cancer care, that's just not possible today. But Time and a progressive ACO can get together and say, here's how we're thinking about it, and that's a whole new market for them as well.
Yeah.
No Medicares.
The dynamic to it play that Will mentioned of the difference between commercial bundles and Medicare and how much more challenging that was, I don't think I fully grasped how different that is to administer between those two markets. And it makes sense hearing it, but yeah, lots of good learning in there.
So while we are waiting for Andrea to join us, let's play some ping pong.
Let's do it. Me start or you start?
I think you can start.
Okay. So first topic for ping pong round, Chapter Medicare Advantage brokerages. So Chapter announced a $100 million round last week at a $3 billion valuation. Big numbers for a Medicare brokerage that has grown pretty quietly in the overall market. Generation Investment Management led the round. In the press release, they reported that Chapter hit $100 million of ARR in 2025, tripling revenue. They also noted they kept headcount flat while doing that, indicating some of the AI capabilities they're building in that firm over there. It strikes me as a really interesting time to be building a Medicare Advantage brokerage model. There was another article out from the folks at Bailey & Co. talking about the opportunity space there, that PE firms, investors are looking at investing there. We've heard recently from Humana in the public markets talking about how their lifetime value concept and how year one, I think it's $1,000 per member in terms of acquisition costs, going down to $500 in year two. We've heard about Scan talking about changing how they interact with brokers. And to me, there's a ton of logic to brokers playing a bigger role here, right? They should, at their best, have a trusted relationship with the member as they are picking plans. They should have an engagement touch point that allows them to engage that member on an ongoing basis. Like, if you're a brokerage thinking about the opportunity right, doing things in the right way, and engaging that membership from a trust building perspective, it seems like there's a lot of opportunity ahead for you in the next couple of years as plans navigate this new market dynamic, try to manage costs, and look to brokers as trusted touch point with members.
I think it's such an interesting question. They talk about the operating leverage that they're seeing, presumably from AI. Is like, what is the role of a broker in an AI future when you can just kind of chat with the chatbot and get what is the optimal thing? Like, do we need human brokers in the loop? I tend to say probably yes. Probably sure. There's gonna be more Medicare Advantage brokers in the future. And you think about a world where people are getting auto-enrolled into either Medicare Advantage or an ACO. And that's actually, it sort of doubles the work of a broker to help them find the ACO or the MA plan or the combination of, like it's an interesting world to think about. And I think it's going to be a fun spacewalk. Would highly recommend the piece from our friend at Bailey, Rebecca. And yeah. I wanted to talk about Function, who I'm always getting ads from. They bought a company today called GitLab, so not today, but last week. And GitLab's, among their other services, what they'll do is they'll bring a phlebotomist to your home or place of work and do your function labs for you. So they'll draw your blood. This is one of those things where it has this sort of feel of a like 2012 or 2020 pitch, because it's hard to imagine the unit economics working for bringing sending a phlebotomist to someone's house. But maybe when it comes to something like Function, it makes sense. I don't know.
I have come to withhold my predispositions of commercial of D2C markets because, exactly to your point, who knows? I don't. Another topic I thought was really interesting this week, second blue bids being the topic. There was a great Substack post by Ryan Peterson who looked more broadly at consolidation in the blues markets. This has been a topic for a while now, right? This question of how do blues plans figure out the puzzle pieces over time? We've seen this happening over time, recent affiliations between Cambia, Blue Cross of North Dakota, Arkansas Blue Cross. I think strategically, as we were even talking about earlier on this call, if you're a single state Blues plan or a single state plan of any type, you got to feel a little exposed in the current market environment, given the various headwinds facing the industry. Blue Cross of Minnesota being a good example of that. You get an influx of UCARE members, and all of a sudden your financials are sideways, and it's like, what gives? Like, how do you navigate that? The way to navigate it, most straightforward, is you find yourself a home with a larger entity that can work through the vagaries of the individual markets one by one. So I thought it was a really interesting piece, contemplating kind of how the puzzle pieces are fitting together in that regard. But what was most interesting is it picked up on this theme of the second blue bid. The second blue bid came out of antitrust issues where employers now have the opportunity, if they, I think it's my understanding of it, if you have a single state blue plan, you can put it out for a second bid for another blue plan to come in and win the business. That was part of the antitrust resolution. Elevance, I think it was their last earnings call, came out and said, we are killing it on second blue bid. Like, we are winning almost all of them. This is going to be a tailwind for us over the next couple of years as large employers offer this up, because as we know in healthcare, scale wins. And so Elevance, as a scaled player, is able to come in now, submit a bid, and I don't think it should surprise anybody that they're doing well in so doing. But Ryan's point, which in hindsight, I'm like, yeah, duh, is that this is just going to speed up that consolidation process. Because if you're a single state blue plan and you lose one of your biggest employers to Elevance, that's a compounding issue on top of the issues we just talked about in the government markets. And so I thought it was just a great point he raised thinking about that. And it's another example of how healthcare is backwards to me. If you get this antitrust lawsuit that is designed to say, no, like more competition, right? Competition is good. Blues are having issues with supporting competition in their markets. And the net result of the answer to that issue is less competition, because these plans are going to all merge into one scaled entity.
To me, this is one of the most interesting questions in antitrust is, you have a market that can sustain a certain number of players. And so if you think about airlines, you think about cell phone carriers, that number is often pretty small. Mm-hmm. And there's this tension because antitrust regulators want to put wins on the board. And so they will block a merger between a JetBlue and a Frontier, or between a T-Mobile and I'm forgetting who the T-Mobile and whoever it was. And what happens is then one of those companies goes bankrupt. So you still end up with less. You end up with a less competitive market, because you kind of need some of the players to get together and be more competitive. And so in addition to antitrust regulators, my sort of proposal is we also bring some M&A bankers in who can kind of help do some matchmaking to keep the markets as competitive as possible. That's and they can collect fees, and that can support the M&A litigation. I want to talk about a little oops from CMS this week. So they acknowledged that they made a little mistake. They had accused New York State Medicaid of giving 5.1 million beneficiaries personal care services. And so that would have been 3 out of every 4 Medicaid beneficiaries in the state. So if you think about that, you're like, wow, that is a lot, getting personal care services. Like, that's an unreasonable amount. Well, What they did was they were looking at monthly data, and they summed that monthly data. So there were 1,000 claims in January, there were 1,000 claims in February. You sum that up, you get 12,000 claims, instead of averaging it to get the average number of beneficiaries in the month. And so the actual numbers were closer to 300,000, which fits pretty closely with the number of people getting long-term services and supports in New York State. No harm, no foul, but a funny adventure or misadventure with Excel.
Math is hard.
It is.
So Lumini in the AI world came out last week, and they announced, I think it was $60 million in total financing, $38 million in a Series B round. And they talked about a new partnership they had with Cleveland Clinic. you just brought up a slide from JP Morgan back in January from Cleveland Clinic talking about how they are thinking about AI strategic deployment. And it's a really interesting question to me, thinking about if you're a Cleveland Clinic right now, how are you thinking about deploying AI across your organization? Cleveland Clinic, at the presentation, this slide highlights they had 4 key AI partners at the time, right? They had Ambience from AI scribing perspective, that's in the middle under that caregiver category. On their patient category, they've got Bayesian Health. And then on the organizational operations side, they've got Palantir and Akasa doing throughput automation coding. All of those companies have really compelling stories around how they're using AI to help healthcare delivery organizations like Cleveland Clinic do things better from an operational perspective. We all know the scribing narrative. And now they're adding in Lumini, which also has a really great story to tell about how it is helping organizations from an AI perspective. As an outside observer, it is then really interesting to me to think about how this story evolves over time. And if you're the individual at Cleveland Clinic in charge of managing all of these AI deployments and thinking about how do we leverage these tools most effectively, what are you doing over time? Are you consolidating these vendors or looking for them to consolidate? Are you managing via some sort of procurement platform the various tools and infrastructure? I think it'll be interesting to watch from organizations like this and think about if you're in that shoes at Cleveland Clinic, what are you doing here? Lumini on their website, so their initial rollout is in the referral management space. They've got a great overview of what they are doing from a referral management perspective. That seems really cool. I also would imagine that if you talk to the Palantir team, they'd be like, yeah, we do that too. And that's where, to me, the rubber's going to meet the road in the coming years is how do these health systems actually figure out how to deploy these things at scale?
This is another area where I will underscore my skepticism that AI is going to actually reduce jobs at health systems, because it's not just one person, but a whole team of people who are needing to manage all of these contracts. And so you're taking maybe a group of people away from this one, but then you need to rehire people who are like, yep, I manage the Palantir contract.
Sure, yeah. Totally.
And I'm negotiating with Palantir versus Qualified versus Lumen AI on all of these things. And yeah, I don't know, just color me skeptical that the number of employees is going to be less, and instead is not going to grow as these teams, or as these things get rolled out and the market gets more robust.
Yep. We heard from Story Health. I interviewed them a couple weeks ago about their deployment with Alina for remote virtual heart failure monitoring. And it seems like a very logical thing for a health system to be doing in partnership with a startup. A lot of the narrative, though, is actually we put people on the ground in the health system to understand what the humans are doing. And to your point, it is a labor-intensive activity. And I don't think that's a bad thing either necessarily. I think it's just the way, like, it is organizational design 101. It is how these big organizations work. It is a fact of life.
Yes. Well, we have our last, but certainly not least, guest of the day joining us. I'm going to bring her forward. Andrea, welcome to the show. Thanks so much for making time today. I know you had a busy day.
Oh, thanks so much for having me. So honored, and I'm such a fangirl. So truly appreciate the opportunity to be here.
The feeling is extremely mutual. Congratulations on the round. Talk to us a little bit about, 10.8 million led by Morningside and Hesperia. What? First of all, actually, for listeners who are not familiar with SimpliFed, what do you guys do?
So SimpliFed is a maternal care at home platform. And to date, we've been very centered on our core business of virtual breastfeeding and baby feeding support. So just a tiny bit of background, 85% of women want to breastfeed, but only 25% are reaching medical recommendations. And what we all know is that we need to be inclusive of all feeding options, whether you're feeding with formula or breast milk, whatever that looks like to you. But what I learned in the course of my journey as a patient, and my first daughter inspired this, and very proud to say that my third daughter and I are patients on SimpliFed, is I learned that most parents want that inclusivity of all feeding types, and they also want it to get paid by insurance, which is technically required under the Affordable Care Act. So what SimpliFed does is we work as an extension of OB-GYN practices, healthcare systems, and other partners. And we help democratize access to insurance-covered breastfeeding and baby feeding support. starting during pregnancy, and we continue working with families throughout the postpartum experience. And what we've learned, and this has been such a central part of our Series A raise, is that baby feeding is this no days off, no nights off activity, and represents this very powerful engagement tool and wedge to tackle the broader maternal health crisis that we're in right now. And so SimpliFed is evolving from this virtual breastfeeding and baby feeding support model to this more comprehensive virtual OB model, and happy to share more about that.
Yeah. Andrea, I'd be curious, as you're talking that through, the intersection points with the health systems and the existing provider base is really interesting to me. I'd be curious to hear a little bit on go-to-market strategy and how you've been thinking about that over time. I know we talked with you and Health Tech Nerds community last year about fee-for-service contracting and Medicaid going in network. I'd be curious how you're thinking about both payer, provider side, what conversations with both those entities are looking like these days.
Absolutely. So SimpliFed's whole care model is fully covered by commercial Medicaid and TRICARE health plans. And one of the things that we've done is we go in through, we have very strategic relationships with health plans, but we also go the old fashioned way via provider enrollment. And right now, as an example, based on partnerships, we're serving about 50% of all commercial health plans across the US. So all the big ones you can imagine. And so now we're going after those regional commercial plans. But a central part of our go-to-market is the fact that we act as this extension of healthcare systems, OB-GYN practices, and other strategic partners. And what enables us to do this is our maternal health operating system. And I'm very proud to say that's officially trademarked. And we've built our own native EMR. It's AI-enabled, of course, these days. And we're able to deliver personalized care pathways tied to patients. But what we've really done is that it is interoperable with all the major electronic medical record vendors. And we also have hundreds of APIs that allow us to get embedded as part of our partner workflows. So what does this mean from a patient perspective? Is we get embedded as part of OB-GYN prenatal order set templates. So when a patient hits, let's say, that 28-week prenatal appointment, that's when, for those that know, if you know, you know, I should say, that's when you do that gross glucose chug. So after that, it's the beginning of the third trimester, we get that referral to us, and then we do anywhere from 1 to 3 prenatal appointments. But what's so exciting about that partnership is that, one, it's seamless and it's frictionless. So it's part of the provider's workflow. So it's not a burden activity for them. And secondly, we get access to that structured data from that CCDA file. And then that lets us kick off our care pathway and deliver personalized, tailored messaging tied to that patient's needs. And that allows us to convert, but also ensure that we're covered by the patient's health plan, as an example. Now, what's really exciting, what's happening, and some folks have started covering this, for those that weren't aware, is that right now there's this great unbundling happening with maternity care. So historically, there's been this global maternity obstetric payment. And OB-GYNs would get one large payment for all the prenatal care, labor and delivery, and postpartum care. Well, in the last decade in particular, there's been more high-risk pregnancies. There's been more births after of folks after the age of 40 than there are teenage pregnancies. And by the way, that needs to be celebrated. But with that comes more high-risk pregnancies. And additionally, what that's caused is just a need for more postpartum services. Again, for those that know, there's such a vacuum of care postpartum. So what happens then, that global bundle, is that there's just no incentive to provide care in that postpartum period, coupled with the fact that there are growing OB provider shortages. So ACOG, over the course of series of years, came up with this recommendation. Last year, it officially got approved by AMA last fall. And now we're starting to learn more of the details, and those coding details will officially get more announced by CMS over the summer and then officially approved in the fall. And so Jan 1 of next year, there's going to be no global bundle payment anymore. We're moving back in the world to all fee for service here, which is an interesting trend. We can talk about that. But what that means for a provider like us is that allows us to really serve as that true extension of virtual OB practices, because there's no concern of not being able to bill for those patients, but really to ensure that we are accomplishing what this intent of this policy was, is to really improve access to care for patients, especially in postpartum, where there's a gap of care, And right now, outcomes worse than our parents' generation.
As I'm hearing you talk about it, it sounds like SimpliFed is sort of filling in the gaps between the OB visits and maybe the postpartum visit, and being there for a patient, at midnight or whenever they actually sort of like need the help. I'm curious how you think about like how you staff against that. Basically, what does your care team look like?
So I love this question. So we have a national network of providers. Those providers are internationally board certified lactation consultants. Many of our lactation consultants are also nurse practitioners as well. And so as we evolve from this virtual lactation model to this virtual OB model, that is going to become increasingly important for us. And also we look at the mix between most of our care pathway is synchronous care, one-on-one, at least 30 minutes, up to 60 minutes or longer as needed for medical necessity. But we're also starting to explore the different things that we can do asynchronously ahead of visits, such as different screeners tied to maternal health guidelines, aligned to ACOG and AAP guidelines, I should also say. And so we're evolving how we staff as well as we make this transition from virtual lactation to virtual OB, but also looking at what's the right mix between synchronous and asynchronous care, because dominantly we're mostly synchronous right now.
Andrea, the great unbundling topic is a very fun one. I find one of Martin and I's favorite debates is around the iron triangle in healthcare, which is this general concept that you've got access, cost, and quality, and there are trade-offs between that. And you can't have all three. At best, you're getting two and giving on one of those three. As I hear you describe this unbundling of maternity care, to me, I go straight to this place of, okay, iron triangle, I believe that's a general truism. It's going to be good for access and quality. And I hear you describe that in spades. And I'm like, it's probably going to be a bad thing from a cost perspective because it's incurring, that is fee-for-service care delivery, paying for more. I would be curious, that is how I process it in this moment. I'd be curious how you process that dynamic, those trade-offs at play, and how you think about that, both for your organizationally, but the market more broadly speaking.
So I have a very honest answer, which you're going to get the honest answer out of me. And then I have the other, I would say more PC answer. The very honest answer is that we have been grossly underinvesting in maternal health care in this country, especially as what I mentioned before is that with the evolution of when folks are having babies, there are more high-risk conditions. And I'm one of them, right? I had preeclampsia, I had anemia, I had all those fun things that happen when you have kids past the age of 35. And yet our reimbursement has not evolved with that. So I would argue that we will see increase in costs here, but that's actually, that investment right now during pregnancy and postpartum is the right investment to be making. And here's why. Because we know for all the things that we can do to prevent preeclampsia, things like low-dose aspirin over the counter, that can realize incredible return on investment. When you have preeclampsia, you are 5x more likely to have cardiovascular issues, not just later in life, in near term. And so the investment we make in prenatal and postpartum care, it's probably going to be more costly, but that's going to realize in the short term. And again, let's use anemia as an example. I didn't get my over-the-counter iron supplement because I just didn't know that was something I needed to do. My ferritin levels were basement Hades low. If I'd been taking an iron oral supplement, that would have prevented costs postpartum. So during that bundle stage for those 6 iron infusions I had to do in the an IV plate, like that is very, very costly care. So, I think it all nets out. That will probably be the same, something that to be modeled by our incredible experts in the arena. But what I think a lot of folks, and this is the PC answer, are trying to figure out is how does this become budget neutral? And that's, I think, a role for folks like SimpliFed to play, because their OB practices are going to be wanting to focus on these high-risk patients that, frankly, they can bill more and get higher revenue. And this is where we act as that extension. And frankly, folks like us especially can be held accountable to clinical metrics that are tied to those return on investments. And that's what our tech platform, our operating system is set up to do. So overall, I think it's going to be a positive for the ecosystem, and we're going to have tremendous return on investment for this investment. But I think at first we're going to see a little bit of a blip.
I would imagine that sort of the benefits also accrue for the child postpartum. And when you're thinking about where you started with SimpliFed, like getting having a child who is adequately nourished and at the right weights and everything saves you a whole bunch of ER visits and pediatrician visits.
Heck yeah. So again, let's use like personal stories here. My first daughter, inspiration for SimpliFed. I didn't get that support with baby feeding, and my daughter dropped weight above 10%. And thankfully, in short order, I was able to get below that 10% weight loss threshold. But she was literally hours away from what's called going under the lights for the bilirubin. And that is a very costly intervention. Additionally, we know one of the top reasons why folks are presenting to the emergency room is due to mastitis. And this is due to clogged milk ducts. And these are preventable with the right level of care and support from providers like SimpliFed. And so we've been able to show some of this directional data. We're going through a clinical study right now with our friends at UMass. We're doing additional studies underway. And so we're starting to show these very real improvements in care and able to reduce costs tied to these interventions that we're doing early. So oftentimes with maternity and breastfeeding, everyone likes to cite the long-term impacts of baby feeding. There are very clear short-term impacts of improving baby feeding and support tied to ER, mastitis, bilirubin, preventing that weight loss, et cetera.
And if I'm a state Medicaid agency looking for a change in the sofa, given everything that's going on, this seems like a sort of great place to start. Kevin, any last questions from you before we wrap it up?
I'd be curious, state of the landscape commercially for you guys across Medicaid, commercial. How many births are you guys supporting across each? How do you think about that, those businesses growing over time? And then do you do anything D2C? Do you think about kind of that self-pay, cash pay market separately from those two?
So we're at a really interesting inflection point. So when SimpliFed was started, our first health plan contracts were Medicaid and TRICARE, and then we added in commercial. And so we were dominated by Medicaid and TRICARE, and now it's flipped. And that's mainly due to the pace of referrals that we're getting. But what I can share is that we're on track in 2026 to serve 5% of all births in the US. And so, and I will say that the majority of the patients we're seeing are commercial. And so as we evolve our go-to-market and go live with more healthcare systems and OB-GYN practices, that's just something that will start to level out back to kind of our somewhere in the middle between where we started and where we are now. But we're also at an inflection point because we can serve so many families across US based on our health plan coverage, is that we're starting to explore partnerships that are still B2B, but they look a little bit more consumer. And so, but we needed to get to that inflection point with our health plan coverage because we do have self-pay available, but we just know that we have a 6-visit care pathway. If we want patients going through that 6-visit care pathway, which by the way is tied to all the ACOG, AAP, ABM, like every single clinical recommendation, that we get improved health outcomes. But if we want to get folks through that, it's got to be covered by insurance, which is their right under the Affordable Care Act. So that's something we try to uphold as much as possible.
Andrew, this has been hugely informative. We learned a lot. If folks want to learn more, where's the best place to find you and SimpliFed on the internet?
Oh, well, thanks for asking. So SimpliFed.com. We tried to be punny, but it is SimpliFed.com. So come check us out. It's covered by insurance. Send it to your family and friends. They don't need to suffer in silence. And you can check me out on LinkedIn, Andrea K. Ippolito. So looking forward to continuing the conversation, and thank you so much for having me.
Thanks for coming by.
Congrats on the progress, Andrea.
Yep. Thanks. Appreciate you both.
You. 5% of births is awesome.
Yeah. Yeah, it's very cool. It's a very cool milestone. So we are at the end of the show. Kevin, thanks for your time this week. We will be working to get all of this stuff in the podcast feed if you want to revisit it. And we'll be back with you next week at our usual time, 12 p.m. Eastern, 11 a.m. Central.
See you soon.